Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by my company, Bull Realty. If you need assistance with commercial real estate matters in the Southeast U.S., reach out to me. My email's an easy one. It's michael@bullrealty.com. Well, today we have a great show for you. We're going to talk about retail real estate. You know, things have been kind of up in the air with the economy, with the tariffs, with interest rates changing. Transaction volume had dropped down. It seems to be picking back up. Players seem to be moving a little bit. Let's find out the real story. Please welcome my guest. It's Jim Costello. He's an economist with MSCI, and he's been doing this for 31 years now on matters of commercial real estate and real estate in general. Jim, good to see you.
Great seeing you too, and great being here in person for once. Being here in Atlanta, taking the opportunity to sit down and talk about a topic that I'm really passionate about. So this is fun.
That's awesome. Thanks for being here in studio. And let's talk about retail. You were just, I guess, your hotel last night, and today is at a real nice retail mixed-use development, right?
It really is. It looks right into Truist Park.
Mm-hmm.
We have a new travel app at MSCI, and I used it. I was like, wow, this is amazing that I got that. It was in policy for once, but come baseball season, this hotel apparently like $800 a night kind of place. But it's more mundane today, but it's a nice setting. But what I really like about that location is the mix of property uses. You have Comcast as a big office tenant there. You have the park, you have hotel, you have a bunch of retail and a lot of engagement space for kind of public events. And that's something I like in a real estate development, that mixed use. It's not sort of a monoculture of just, here's a bunch of office buildings, here's a bunch of hotels. It creates that kind of live, work, play environment that in that mixed use kind of world, I think generates a little bit more activity.
Yeah, the Battery, they've done a great job with that. And Atlanta Braves that play there at the Truist Park. And yeah, you can go to see live music there. I've seen live music. I've seen stand-up comedy. There's a cigar smoking place there. You can go to a bar that smokes cigars. Yeah.
But that's an important part of retail, the more experiential stuff.
Yeah.
If you think about like monocultures of property types, think about the old days of just like before 9/11, lower Manhattan, had a whole bunch of office buildings. And at night, everybody would roll up and they'd be gone. There'd be nothing there anymore. After 9/11, they put in more programming to build more housing, bring more retail in there. Yeah. And that created a bit of a balance. So it could be more supported than just by one use. And think about some cities now, they're urban cores where they had people coming into offices 9 to 5, Monday to Friday before COVID. And now after COVID, if you're lucky, you're in a city where folks are in Tuesday to Thursday. But what happens? You can't run a little restaurant in that setting with only 3 days a week as your customers coming in. So that kind of mixed use creates other elements of demand so that if, the office workers are in today, great, they're spending, but then there's folks who live nearby and they come in on other days as well. Yeah. And so it creates a bit of a balance. So the other folks who are opening businesses in the retail in those areas, they can find a more predictable customer base.
Right. And a lot of these properties too, it permits shared parking arrangements as well and better use of the properties. Well, Jim, let's talk about transaction volume, because that seems to impact a lot of our listeners around the country. They're involved in this industry. What do you see as 2024 kind of came to an end?
For retail, we saw growth in retail property sales in the fourth quarter. And that was a hopeful sign in my mind. It wasn't just like one big deal that drove it either, since we're still talking about baseball. It was a bunch of singles and doubles. It wasn't one big home run that drove it in. And the issue is that we've seen a repricing event from the removal of some of the supports that helped drive interest rates to record lows in 2021 and early 2022. It took that long from 2022, when rates started climbing, until the end of 2024 before investors are able to incorporate all that information into their underwriting decisions and start to make decisions about whether they were going to move forward and actually sell something or buy something. It just took a long time for folks to process information and figure out exactly what they were comfortable in doing. So we saw some growth in retail property sales in the fourth quarter. Now, we're not at levels that were at the highs of 2021 and 2022.
Yeah.
A little bit of a tongue twister. But the issue is that, I think people try and set expectations about where the market's going to go. Are we back to the previous peak yet? I'm not sure that's a peak you necessarily ever have to get back to.
Yeah.
Because that was driven by an outside shock. You had record low interest rates. The 10-year Treasury was at about 60 basis points. Mm-hmm. People were hungry for any kind of yield in that point in time. And real estate looked attractive in that because even a low cap rate was still some flowing income. And if you had a tenant that was still paying rents, it was good. And so you had an excess of investor interest at the time. Now rates are up. Deal volume fell as people were trying to figure out what was going to happen next. It's not even at the previous averages from before the pandemic, but it's growing and there's more investor interest there. Plus, the metrics around pricing, performance, cap rates, those are showing some signs of improvement too. To have deal volume improving as prices are stabilizing and growing in some cases, that to me suggests investors have figured out where all the bad assets are, where they don't want to be, where they do want to be, and you're starting to see movement now.
Yeah, that's a good point. And we've seen the same thing on the brokerage side where people were kind of frozen in their tracks a little bit because they're like, well, if rates are going to come down significantly, why would we buy or sell? And now it seems like a lot of our clients, we still have some that say, oh, I'm going to wait till interest rates are free. But now we're seeing buyers and sellers like, okay, I think rates are more historic normals and we're not going to materially change. What's your thought on that? We had the 10-year Treasury that seems to be creeping up while the Feds are going down. What would you expect for rates moving forward?
Yeah, that spread is increasing between the 10-year Treasury and where the Fed rate is at. Mm-hmm. And that's a sign of some uncertainty in the marketplace. Mm-hmm. People unsure about government policy, what's going to happen with government spending, government debt and deficits. Those kind of issues are in people's mind. And so they price in a little bit more risk there just in case. So that's just there.
Yeah.
Is it going to change? That's probably above our pay grade to say what will happen next. But investors are certainly reacting to it. Mm-hmm. And so they're pricing in some uncertainty. And in that uncertainty, if you've got a well-located property with some cash flow and a stable tenant, that's not a bad thing.
Yeah. So if the Fed's, is the Fed kind of indicating now that they may not reduce the rates any this year, or maybe once or twice potentially?
The stuff I've seen suggests that they're taking a wait and see attitude at this point, not being too aggressive to try and undermine anything. You have a nascent recovery. The worst thing that could happen is if they spook everybody again. And so there's been some good job numbers, and so inflation is still not where everyone wants it to be. I think we're going to have a hard time getting it back down to like the 2% range and lower that we saw in the past, mostly because of real estate. A third of the index is driven by the apartment rents, and it's kind of an unusual kind of 3-year lagged index, kind of like the NOI for a building, so the average of all leases negotiated over the last 3 years. And that has lagged a bit in terms of how quickly it responds to the slowing and declining rent growth in certain markets. So it's still going to be sticky for a bit. It's hard to just expect that to turn around overnight.
Yeah. What about the 10-year? Is part of the reason that it's higher than we'd like in the commercial real estate world is because it impacts mortgages a good bit, right? Is it because of the tariffs and what kind of the market kind of waiting to see what happens there? Or?
Well, all that increase in the 10-year and mortgage rates, even as the Fed kept cutting, that was well before anything with the change in administration. So those are separate issues. I mean, it was already, there was some uncertainty in place even before the Trump 2.0. This is still an issue. The tariffs, though, and talk around that does add to some uncertainty because it's a new risk that investors have to think about and underwrite and figure out, is it really going to happen, or is it just a negotiating position to get them to someplace else where they want to be? And so that is where I think people run into trouble. The one thing that's been clear is that President Trump in his first administration, he would take just a negotiating stance. It was pretty hard. This is not unusual to folks I know in the New York commercial real estate world who have dealt with him on a business level. He would always be very aggressive and take stances that people felt were shocking at first, but then come back to something that was more workable and then say all kinds of wonderful things about you because you got a deal done. and the fellow is a deal maker. Yeah. And so if you look at it in that context, some things may seem extreme, but then there's other reasons behind it. So you got to be careful and not just think that everything comes through exactly as outlined. Maybe there'll be some other things that come through, but you have to think about, what are the range of scenarios. Mm-hmm. So it does add some uncertainty, though, because until you see how a final deal is negotiated, then you're playing with all these different scenarios to see what if it's more extreme, what if it's less extreme, mm-hmm. what's the range of outcomes. Mm-hmm. I don't think you can just point to just one and say it's going to be exactly this. So you always need to do scenario planning, I think, in this world of uncertainty.
Yeah. And today we're talking about retail. So I guess it's possible that tariffs could impact retail possibly more than other sectors, right?
Yeah. The way to think about tariffs, it's a tax consumption activity. It's paid by the folks who are importing the goods. It's typically a distributor bringing something in, selling in the stores. And so the challenge is who's going to pay for that extra cost. There were tariffs implemented in 2018 that would have increased costs, but it didn't impact consumers at all. What happened then is that it impacted the stock market. The firm bore that cost. There was too much competitive pressure from retailers in the U.S. economy where they had to eat that cost themselves rather than losing clients. And if the same thing happens today, we could see a bit of a hit in the stock market for those companies that are importing, but eventually they'll find some economies of scale and get some growth out of that. And consumers would be okay. The fear is what happens to consumers if the firms are just so tapped that they can't absorb that shock. And in that point, if the firms are able to push their increased cost onto consumers, that would have a bit of an inflationary impact and hurt household spending. So, and the other risk is maybe it's not an either or, maybe both get a bit of a hit in there. You just don't know. Yeah. The last time we saw the tariffs increase, that was fully implemented, fully absorbed by the firms. We'll see what happens this time.
Tell us about consumer confidence. Where do you see that now with all this going on?
I haven't looked at the consumer confidence number in a bit. I've been looking at other things recently. That's one I just haven't dug into recently.
And it seems like just when I look around Atlanta, at least where I live, the stores seem to be packed and people seem to be spending a lot of money. But let's talk about retail performance. As we're talking about retail real estate, how are these retailers performing? How are the properties themselves performing rent rate-wise, rental rate-wise, and occupancy and those sorts of things?
Retail properties, there's some divergence in performance based on the type of property. Mm-hmm. But if you look at, say, the malls, lifestyle center, super regional malls, so kind of group in one category, taking a look at the NOI per square foot from the MSCI U.S. Quarterly Property Index. We put an index together tracking the performance of all these institutional portfolios. And so you can get underneath the machinery of how you calculate a return and get the NOI. If you look at the NOI per square foot for just that mall stuff, it took a big hit during the middle of the COVID crisis because nobody was going to a mall. Yeah. But revenge spending came in and it surged back up. And now in the third quarter of last year, I didn't see the fourth quarter numbers yet. It was 9.6% higher than the pre-COVID peak. So that's a good sign. Now, There's a bit of a bias in that index. There's a survivorship bias because it's the institutional quality properties.
Right.
It's the stuff that the institutions hold. Class C dead mall, that was part of the Centro deal in 2007. Because that deal averaged at like $200 a square foot for a lot of those malls. There's malls that have traded out of that holding now at like $7 or $8 a square foot. I mean, tremendous losses. It is like land value at that point. Yeah. But that's typically like in these Midwest dead industrial cities that lost a lot of jobs. And so the people who bought polyester pants at these places in the 70s, all those jobs are gone, so they don't have to spend money there anymore. Yeah. So there's very much a winner and loser kind of context there. But the ones that are the good malls and the well-located and good income, on average, they've recovered past the COVID lows and to new highs. And so that's a helpful sign for those investments. There's more uniformity in the neighborhood and community center market. You don't have that extreme divide of pure winners, pure losers, because that's more focused on the day-to-day needs of folks and some of their consumption activity. A lot of groceries, and whether market's up or market's down, it's got to get groceries. So there's more stability there, and it's shown steady growth in that NOI per square foot over time. Just a little bit of a dip here and there with an economic downturn, but the level was 12.5% higher than the pre-COVID peak. So we've washed all that away, and income is climbing, and that's one of the reasons for those two sectors. That's one of the reasons I think that prices for retail properties overall, the only two sectors right now that are growing for prices are industrial. And there's a great story on industrial. Everybody understands that now, the shift to more logistics activity and everything, but retail as well. So now it's the bags and boxes where you get that growth in property pricing, but not all retail. There's one that's still a little bit problematic. That's more your triple net retail because there's no income upside there. It's a fixed payment over time tied to the credit of the particular tenant. And so it's more like a bond than many parts of the real estate world. And the cap rates there have gone up, even as cap rates for the other types of retail I was talking about have started to moderate their increases. They've started to slow. So like triple net retail, something like a 6 was the average we're looking at, and it's climbing up closer to a 7. With no sign yet of any slowing or moderation of that increase, as opposed to the other elements of retail, where there's more ability to increase rents over time. Some of them have percentage rents, and so if you have an inflationary period, that might flow through and help your income. So the income side is helping the other sectors. The other one, the triple net, that's still a problem until people kind of see where the bond market stabilize.
Yeah, and that makes sense. So as a lot of these single tenant properties, you don't have as high of increases, and sometimes they're even flat. So it makes sense that a higher interest rate would impact that cap rate much more, right, than these multi-tenants that in most cases have annual escalations in their rent.
Exactly.
So that does make sense. What about transaction volume health in the different markets? What are some of like the top 5 cities that you've seen with it do well there?
The top 5 cities, it's starting to normalize to go back to the same set of markets that were in place before the pandemic. Not entirely, but it's getting there. The pandemic really impacted the expensive coastal markets more than other markets. There was more of a worry because of very dense populations, people leaving some of those cities for a time. And so the activity pulled back more in some of those locations than others. But they're starting in our rankings of markets. They're starting to climb again. They're not all back where they were. Manhattan is not back where it was, but it's climbing in the rankings. And then these big sprawling markets like LA and Chicago that have lots of different malls and neighborhood and community centers and just a big population base, they're starting to climb in those rankings as well. Traditionally, much of the rankings of retail property sales really just focuses on what's the size of the market. If you got more people, you got more retail. Yeah. And so you just sell more of it. That changed for a bit, but it's getting closer now to be just driven by the size of the market.
Right. Yeah, well, that makes sense to see that goes on. Well, Jim, what's your thoughts about retail real estate moving forward through in 2025? What do you expect to see happen?
Yeah, the thing about retail, it's been a sector that people have thought negatively about for a couple decades now. I remember in the mid 1990s when people were just starting to go online and do some very small e-commerce stuff. There were a lot of folks who were writing, "Oh, retail's dead now. Yeah. Everyone's gonna buy everything online forever."
Like Office was last year.
Yeah. and there's always that first knee-jerk reaction. Oh, one thing changes, and so I just follow it in a linear fashion exponentially into the future, and therefore all retail's dead. That's the way people approached it. But a more thoughtful approach was just to look at, well, what drives retail? It's the spending. What are the patterns that drive spending in the economy? What's the demographic patterns? What are the consumer good patterns? And taking a look at that kind of stuff in the mid 1990s, the thoughtful people in the sector understood that, yeah, you'd see some detraction from retail over time from everything from the internet, but it wouldn't get rid of all need for in-person shopping activity. And the things that would survive would be more of the high quality stuff. So folks who were really thoughtful, they repositioned their portfolios to deal with that. So now we're in a situation where the consumption and how much consumption happens online versus in store, that spiked tremendously during the pandemic because we're all stuck on our couches and people are just going to Amazon because they're bored and everything was coming in that way. That share has come back down, and that share came back down, but not exactly to the exponential trend it had been before the pandemic. We've seen so much of a move of goods being bought online that you're reaching a saturation point where there's not that extra growth. I mean, in the early days, online shopping was growing at double-digit rates every year, far outstripping the growth of personal income and the growth of just what families could spend. But it was growing so much because it was robbing Peter to pay Paul. Eventually, that has to stabilize. So that rate of online shopping it's still growing great, but it's not at the same pace it was. And it shouldn't be, because at some point it should just grow in line with total consumer spending, just like in-store stuff. And then it'll just be driven by personal income growth. But we're approaching that point. Is it going to be 5 years? Is it going to be 10 years? I don't know. But at some point it starts to normalize. And along the way, a lot of old dead retail has been demolished because if we look at the GLA per capita across the U.S., it's starting to fall. And that's the first time in a long time. There's still some retail construction, but it's nowhere near what we did like in the 70s and 80s when we had this big expansion into the suburbs and decentralization of a lot of U.S. markets. You had to build a lot of retail to support it, and they overshot. And so we've been dealing with that overshot basis, or that overshooting for some years now. And that's just being demolished in some cases. And so as that kind of gets cleaned up, the survivors don't have as many kind of scabby malls at the end of the road they got to compete with. We're trying to get a tenant in place. And that helps improve the performance as well.
Yeah. So your thoughts then for 2025 are more of the same that you've seen in the fourth quarter, I guess, and that would be basically what, strong performance and cap rates steady, or?
Depends on a bunch of things.
Yeah.
The uncertainty is a killer.
Yeah.
If people start getting too worried about tariffs and about the consumption impact, that might change their underwriting, may make some buyers a little bit more cautious. Hopefully, it doesn't have as much of an impact on households. Households are already kind of strapped, but that's also something to worry about. Inflation did bite into what people can spend. People are frightfully aware now of the price of eggs and which way it's going. And, that kind of stuff is really what we got to worry about. If tariffs are implemented, are firms able to absorb that cost, or do households have to absorb that cost? That's who knows? That's the uncertainty you got to worry about. But if I'm a buyer, I got to price in some uncertainty on that, and that might cause a few hiccups here and there. But aside from that, we're removing some of the dead space. There's still some high quality stuff that's out there. Prices are growing. And I think importantly, the purchases so far have been private folks. That it's people putting their own money to work who have led the recovery. This is what we've seen in the past. Institutional money, there's a reputational risk they have to worry about. Mm-hmm. If an investor participant in our ACOE index decides to jump the gun early and raise some money for a fund to buy CBD office buildings, and it takes another 2 years for prices to actually start growing again, that fund might underperform relative to other funds. And so then, 5 years from now, when they go to raise the next fund, because they underperformed, they're probably not going to get that money. So they're always a little bit hesitant to kind of call that turning point until they see those signs actually turn the corner. And on that, we're starting to see, we had some good numbers for returns in the fourth quarter. It was positive again. And that if that continues, you get a couple quarters of positive growth in returns, then you can see the institutional money come back in a good way, and that'll help lift deal volume a bit more.
Yeah. Yeah, it's interesting to see more of the single asset private investor, moving the market a little bit. And you mentioned some of the stock being removed from the market. But it also seems like higher interest rates have caused new supply to dwindle, right? And have you seen that and the impact there moving forward?
Yeah, new supply has faced some challenges from construction. Construction, it's not just an interest rate thing, though. I mean, it's also just a labor issue. Finding construction labor is difficult in many parts of the U.S. And, there's a whole bunch of issues behind it. One is that after the global financial crisis, a lot of folks who had jobs in construction were out of work, and it was going to be a bit before more construction was needed. Mm-hmm. And just seeing the volatility and the challenges of what they went through, some folks just left the industry entirely. Yeah. And then there was also an age issue in that with a lot of folks who were just, been working in that industry for a while. It does beat you up. It's, here in the office, it's pretty nice. We don't have to deal with hurting your back from lifting too many 2x4s, Yeah. So, folks also aged out of that as well. And replacing those workers adds to construction costs. Yeah. And we need better systems in place to motivate young kids to learn all the benefits of working in the construction trades. Not everybody has to go to college and become an English major. And I mean, what's that get us? More baristas.
And be an economist.
Well, it worked out for me. But there's some degree programs, maybe, just, in fact, like the credit markets, there's like hedge funds that trade in student debt, and they know which degree programs are more valuable than others just based on how well they're able to repay. And so, some programs the kids are going into, they just don't pay for themselves. Whereas if they had got a job in the trades, there's a stigma, though, of like, oh, you don't have a college degree. But, maybe you get like an associate's degree in the manufacturing arts, using the junior college system, get rid of some of that stigma, get some real good training that way and kind of channel these kids into things the economy needs. But and that's I'll get off my soapbox now.
And then you add construction cost and you look at high interest rates, and it doesn't seem like a lot of land prices have come down. So that's kind of curtail new supply, right?
Yeah, determining where land prices are at, that is a tricky thing right now because there's not as many sales comps. And so then different approaches to come up with a land residual are giving different results. And so there's always a bit of a debate in the transaction world about, well, what is it really worth? And with that kind of uncertainty, it makes it easier for buyers and sellers to stay apart for a while, as long as the current owner can afford to sit and wait.
Yeah. Yeah. It's interesting. I'm selling some downtown Atlanta sites, and for the first time in my opinion of value and guidance, I'm looking at air rights in Atlanta. So it's like, that's when downtown is doing better and maybe the place to be. Well, Jim, to end today's show on retail, where might there be some opportunities for investors or developers? Or
this triple net retail that has seen the challenges of increasing cap rates, at some point, you'll get some stability in the bond markets where people understand how much more inflation there is, how much they should price the risk of these, and then you might see some stability in cap rates. So far, it hasn't translated through to the deal market for those triple net retail kind of assets. But you get some stability, then people can see just how it should be priced, and it might translate to the same kind of stability in that deal market. The other stuff, I think the real opportunity moving forward comes from just the fundamentals. We have a challenge in the market right now that, like any building you buy, on average in the United States, the holding period for commercial properties is about 7 years. So anytime you bought a building from someone or sold a building, it's a transaction where the previous buyer, 7 years earlier, probably had a higher cap rate and a higher mortgage rate than what you could get in the market today. And that was true up from the mid-1980s up until 2019. So we had a couple generations of real estate investors who made money just by showing up. You could buy an asset, mismanage it, use the wrong broker to lease your space, overspend on CapEx, and still sometimes sell a building and make money just because cap rates compressed along the way. That's not happening anymore. Even if, best case scenario, you get a flat 10-year treasury at exactly where it is now for the next 10 years, you're still going to have that capital market forces as a headwind as opposed to a tailwind moving forward, just because of everything that's sold in this QE world where there was just free money out there, and which really helped reduce rates for a long time. That's gone. We're more in the quantitative tightening mode now. We're in a higher rate environment. And if it stays there, and even in the best possible case of just staying exactly where we are, there's a whole bunch of properties that after that 7-year period when someone's itching to sell, they're going to be selling into an environment where the next buyer can't do what people did in the past. Yeah. So the way to make money there's two ways to make money there. One is just by being hyper efficient in how you manage an asset. Yeah. And so maybe there's some gains to be had through agglomeration, take a lot of smaller portfolios, put them together, run them better using technology from a big firm. So maybe you get some more mergers and acquisition type deals. And there's some evidence and talk from my friends in the DC policy world that mergers and acquisitions may be easier moving forward because of some work to change regulations there. That could be interesting. Mm-hmm. The other thing is if you do have this environment where you have someone who wants to do a deal, someone wants to buy it, but it doesn't quite fit because of that change in the capital markets environment. The other opportunity is to maybe be that high yield lender, give them a little bit of a high yield mezz slice to help them over the hump to get that deal done. Mm-hmm. So there's been a plethora of new credit funds aimed at providing that kind of activity as well. Yeah. So there's opportunities in that market, but it's going to be a bit challenging.
Yeah. Yeah. Well, good point. And, I've seen a lot of sellers feeling a little more comfortable that rates are kind of normal historic. And if you can take a profit or not and move down the road with your next mission, it makes sense. And I'm also seeing more lenders feel comfortable with their underwriting and buyers feeling comfortable. So interesting to see what happens in 2025. I hope this transaction increase that you've seen in the fourth quarter keeps going.
I can bet.
I hope so. Jim, thanks for being with us today.
Oh, thanks for having me.
All right. And thanks for being with us around the country. Hey, please let us know what you think. Comment on the show, like the show, connect with us on your favorite social media. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. by Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.